There's a bunch of conventional wisdom in Silicon Valley that I either think is always wrong or mostly wrong. An example of that is you always need a co-founder. Michael Dell didn't have a co-founder and Jeff Bezos didn't have a co-founder.
What is the most common mistake that you see AI startups making nowadays?
Your thing isn't working and you stick with it too long. There's radical openness to trying things that didn't exist 3-4 years ago. And that's really important in a way that I think few people really understand.
Very excited to welcome a close personal friend and a close friend of SPC here for a -1 fireside chat. Elad, I think you are the first guest who's coming here for the third time.
Wow. They keep inviting me back. I don't know why. So thanks to you, Frank.
Keep on raising this big ass fund so we keep on, needing to invite you back. So Elad, we've been here for 3 times. I guess to kind of start off, you have a bunch of folks in the room, all of various stages, I would say, of ideation, figuring out what they want to work on. And you know about the -1 kind of like, I would say stage yourself. You've kind of started companies. You've kind of been, not just started a company, started a new venture fund. But the first set of problems I want to talk about is how do you do -1 in today's day and age that might be pretty different than 5 years ago, when the capabilities for building seem a lot more pronounced, but also the ability of what you build is, kind of in some ways a lot more commoditized. So how would you go about doing -1 today if you were starting a company?
Yeah, I think there's multiple ways to start a company. So I don't think there's like a single prescriptive approach or like a single right thing. I think fundamentally there's 2 or 3 different ways that you can approach things that are still pragmatically true. One is obviously being very customer centric. Sometimes it's just building for yourself as a customer. That's Brain Trust, Ankur Goyal's company, where it's an eval and prompt background and, et cetera tool. And he built that for himself effectively as a potential user. That's something he kept beating over and over. You can also do that for specific customers. So one approach to the world is doing that of being very customer centric or honestly self-need centric. Second approach, which I think is really interesting in today's day and age, which I think is very unique, which is I'm starting to see people do these AI-driven roll-ups or buyouts where they're effectively buying companies and then expanding margin dramatically using AI. And there you need 3 skill sets. You need the ability to buy things. You need the ability to operationally change them, which is often the hard part, the change in management. And then you need to do the AI stuff on top of that so you can actually expand margins and make it a better business and make it more software-like. And then, there's a third, which I know most of you is kind of a grab bag, which is, you iterate on different things, you invent things, you run it by, you try customers. That's kind of almost a traditional approach. And it's a little bit more of a winding road in some cases where you come up with an idea and then you try and embed it and, see what people think.
So, okay. So let's perhaps say our topic would take a slightly different approach, which is...
and by the way, sorry to interrupt. I do think things are faster now. And so I think that part is dramatically faster and better. And then I'd also say faster in 2 ways. One is you can build things much faster, which makes a big difference. But the second way is customers are very interested in trying stuff in a way that I haven't seen in my lifetime. And because of AI, every CEO has the edict of you need to do something in AI. What are you going to tell your board about AI and how are you going to do AI? And so there's radical openness to trying things that didn't exist 3-4 years ago. And that's really important in a way that I think few people really understand. And so I remember when I was diligencing, I invested in Harvey, the AI legal company, really early in their first round. And then I led their Series B. And for Harvey, I remember calling their customers as doing diligence, and I called these big law firms and I asked them, and usually law firms, by the way, are really bad adopters of technology, right? They're very slow. They're hesitant to change. There's big security reviews. Like many legal laptops are completely locked down, right? You can't download things onto them without like CIO permission at the law firm. So I call these people running these law firms, the 10 biggest law firms in the world. And I ask them, what is the biggest change you expect the party and why you're adopting it and all the rest? And even 2-3 years ago, the insight was so interesting and unexpected, where they said, we think this will augment associates to the point where we'll need fewer of them for the same book of business, but we can grow our book of business quite a bit. And we grow partners from associates. So who are going to be our future partners? Are we going to have enough associates per partner to actually have the right number of partners? Like it's part of the training, it's part of choosing people, it's a selective criteria, it's the filter, it's like whatever you want to call it. And I thought that was fascinating as an insight. And this was an insight like 3 years ago or whatever it was, 2 years ago. And so I do think there's other aspects that are really overlaid on this that are like super fascinating.
Would you say that as an extension of that observation that there is more openness to buying today than has been probably in our generation, is that If your stuff is not taking off today, if you're having a hard time selling your thing today, then that's a pretty bad spot to be at.
100%. And I take it a step further, which is even a couple of years ago. So I think there's a bunch of conventional wisdom in Silicon Valley that I either think is always wrong or mostly wrong. And an example of that is you always need a co-founder. And you look at the biggest market caps in the world, and Michael Dell didn't have a co-founder, and Jeff Bezos didn't have a co-founder. And, you go through company by company. Steve Jobs was a dominant founder. There was two founders, but he was really the main one, although Wozniak, of course, built everything initially. But you kind of go company by company, and either it's unequal in most cases until YC, right? YC and Google was roughly equal, though Larry had a little bit more stock even early on.
Larry Ellison, Mark, no co-founder.
No co-founder, right? So you look at many of the Bill Gates co-founded with somebody, but then he really became the sole founder when Paul Allen left. So over and over is either unequal or solo for many of the biggest things. Now, there's lots of people who have co-founders who have been incredibly successful. In some cases equal, in some cases unequal. If you actually look at cap tables as companies go public, you actually realize that most things were unequal. And it was really YC that normalizes equality. So anyhow, there's a lot of conventional wisdom that I just think is wrong.
I mean, we don't love equality. We love winning, right?
Yeah, no, I think winning is important for startups. People often ask me, what is the single biggest determinant of culture in a startup? And I say winning. It's not the kombucha, it's not the ping pong table, it's, not the number of GPUs you have, although that is exciting. It's winning. But anyhow, back to the original question, the companies, at least that I've been involved with that have tended to work early. And it's not like we're going to grind for 70 years and then the thing will work. And it's usually something starts working really fast.
Yeah, it's actually interesting you bring up that particular statement. One of the precise lines I remember from when you spoke last was actually that for startups, they can often just kind of be wandering around for a while. But when stuff works, it tends to work very quickly. And there's some cases where, success happens some slow curve, but the best companies, when it starts turning the flywheel, it turns even quicker. So I think I'm combining the two things. What I'm really hearing is that if in today's day and age, you think you're building something, but you're having a hard time selling it, that's a pretty bad signal, because I agree that there's propensity to buy across almost every vertical, including old school regulated verticals that we haven't seen in a while. And also, if it's working, it should be working quickly, right?
Yeah, this actually ties into competing schools of thought in Silicon Valley around are there enough founders in the world? So the YC school of thought is if you just have more founders, more magical things will happen. And on the alternative viewpoint of the world, and I think both are partially correct, is there's only so many markets that are open in a given moment in time. And therefore, there's only so many markets in which you could build a big company. And they're open because of a regulatory change. They're open because of customer behavior. They're open because of technology shift, right? Right now, we're going through a simultaneous massive shift in technology and a massive shift in buying behavior. So many more markets are open right now than I've ever seen in my lifetime.
One of the frameworks we talk a lot about at SPC is like, are you in modality 1 or 2? Modality 1 is that it doesn't actually matter if the shit's good or bad. The only thing that matters is how pretty it's drawing, right? And often in those kind of like domains, there's often not just one player, there's often 2 or 3. It's often pretty neck and neck in the early days, but really the only thing that matters is actually winning. And in modality 2 is you're actually building something actually heretical / non-consensus. But by definition, that should mean that you should find it hard to get funded. You should probably not mean, most people should actually laugh you out of a room, right? Or they should say that like this actually doesn't make any sense. And I think a lot of people want to do modality 2, but they're still seeking kind of like the validation of, whether it be customers or employees or investors. And I think modality 2 is actually very lonely. And I think there's not that many companies that I think are able to pull that off. I'm curious, have you seen any good modality 2 companies?
There's a few, and there's also a lot of stuff that took off in ways that people didn't anticipate, right? OpenHaul would be an example of that, but also ChatGPT. It was launched Thanksgiving week. This is is a buried launch.
November 2020.
It was like, nobody's going to pay attention to this anyhow, so we'll launch it during Thanksgiving. So like, what does that be in terms of our ability to predict what's going to be compelling?
So today we have 3 to 4 players. Let's call it 3 players who are kind of dominating the frontier. I will say 4. There's obviously, OpenAI, there's Anthropic, there's Google, and then we'll put all the Chinese open source models into their own kind of bucket, right? So let's say there are 4 kind of big categories Do you think that this is a stable oligopoly, or do you anticipate this shifting, call it in a 5-year time frame?
Yeah, and then I probably had XAI as an ongoing wild card.
Actually, sorry, you're right. I mean, if you want the means and what's happened right now, you should go raise. Yeah, as in that Grok is the best of that.
Yeah. So I wrote a post about this maybe 3-4 years ago where I tried to predict the foundation model market. And at the time, what I thought would happen was that you'd end up with 3 players, each of which would be aligned with a hyperscaler. And it'd be kind of a captive hyperscaler model relationship where the hyperscaler would fund it and then IP on that platform. And so I thought it'd be Google for itself with GCP, and then OpenAI and Microsoft because there'd be a relationship at the time. Then I thought Anthropic maybe partners with Amazon or something. And then I thought NVIDIA would be the primary funder of open source. And if you look at every technology wave, there's usually a big company that funds and monetizes the open source. So during the 90s for Linux, that was IBM, where they spend billions of dollars effectively on Linux development and really monetized it by selling it through services. And I got it wrong. I got it partially right and partially wrong. I got it right in terms of thinking it'd be an oligopoly market. And the reason I thought it would be an oligopoly because of the scale of capital needed to do it. So eventually you just don't have new entrants really able to compete. But I got it wrong in a few ways. One is Meta ended up being the US-based funder for the time being. And China, the Chinese government became the other major source of economic funding for open source models. And then I got it wrong in terms of the models are partnering more aggressively across, right? Anthropic is partnered with GCP and Amazon. Microsoft is working with multiple models. Google is working with Anthropic. So it's much more of an overlapping world than what I anticipated, and everybody kind of cross-invested. It's actually honestly closer to what happened in China across a few different waves of the big Chinese companies effectively funding the versions of Uber and, other sort of next-gen applications. So I do think the natural structure, assuming one of the companies doesn't truly lift off in terms of model capabilities ahead of everybody else, is oligopoly. That seems like the natural state for now. I do think one interesting thing that's emerged is the importance of the harness. Relative to some of these applications like Claude Code, I think a big shift there that I observed was when 5.2 came out for OpenAI, there was less switching than I anticipated because some people argued it was a bit of a better model. But people had already been using Claude in a harness that was really optimized for using Claude. And so fewer people switched than I expected would. It could be the model's only incrementally better. It could be a variety of things. So an open question to my mind is how much does the harness matter for stickiness now versus the core model? And if that transition happens, then that has really deep implications in terms of how you think about things. And then the other piece of it that's the interesting question is when do the certain types of models asymptote in functionality? And if you hit the asymptote, then other aspects become more important in terms of switching or not. If you don't hit the asymptote, then it continues to be what's the best model. Again, with this overlay of, is it significantly different enough that you'll abandon whatever harness you're using? And then the question is what's the enterprise version of the harness?
I don't think anybody in this room could probably confidently predict whether we are hitting that asymptote because it seems as though we've kind of been in a 3 to 4 month kind of cycle of someone having a leap for the last almost 3.5 years. So I tweet a lot about Claude Code, which means that I have people who are my friends at OpenAI Codex being like, yo, can you switch and use it? And I'm like, no, I have a bunch of context and I know how to do these things. It's hard for me to switch. So I think the hardness thing is real. And it has also surprised me that hasn't been as much chatter about trying out 5.2 or some of the more recent models. And maybe you're right. Maybe it's incrementally better. Maybe we're not, I think Opus 4.6 came out, pretty close to 5.2. So maybe all of that is contributing to it. But I guess the question in here is, do you think that we are running out of model iterations that are significant? I don't personally think so, but I created it today.
Yeah, no, I think there's tons of room. I think the question is more, what is the closeness between the models and what is the utility you get through things that are ancillary? And the ancillary things include the harness. It includes brand, actually. Yeah. Right. What you could tell your friends you're using. Yeah. No, seriously. That matters. So I think it's a couple different things. You just get used to having things configured a certain way, different types of prompts, or, everything is kind of set up for you. And I think it's a recent phenomenon. I think it's very new. And that's why I think it's not discussed very much as a thing.
As you kind of, from your vantage point, obviously we're still continuing to, I would say, innovate along, okay, let's do longer chains of thought. Let's do better RL. Let's do longer context. Let's do multimodal. Let's do omni-modal. Let's do like worlds models and so on, right? So how are you, like, when you kind of think about the vectors along which these models setting group over call it a 18 to 24-month horizon, how do you think about it? At this stage, you might as well go work for a foundation model company,
Yeah, we all will be in the long run.
Yeah, we are.
I'll get absorbed. Yeah, when I work on a railroad.
Yeah.
It's very durable. So I think there's a few different types of models, right? So there's the core language foundation model, like the LLMs, et cetera. That's mainly what we talk about. And I think there, 2-3 years ago, everybody thought, okay, this is going to go agentic over time. And for agentic things, you need some form of persistent memory. And you need to have these sort of actions, and you need to be able to tie into these different, this to integrate with these 30 things. Like I think it was kind of clear what to do, and it's just a matter of time to go do it, right? We knew reasoning was coming because we'd seen reasoning in other contexts, and so I think a lot of it has been reasonably predictable. And we knew, I remember talking to Eric Steinberger, who runs Magic. And 3 years ago, he was talking about super long context windows being incredibly important for code, because then you could put the whole code base in and you could work across it. And, so again, I think a lot of the smartest people had all these ideas and now sort of substantiated. And similarly, I think there's a very clear roadmap in terms of what's to come. For other areas, I think there's lots of really cool stuff to do. So, what are the best models for physics simulation? What are the best models for materials? What are the best, you kind of go through vertical by vertical or area by area. And I think there's super interesting stuff to do. Now, that may be severable for economic value, right? And that's my big question about a subset of the bio models. I think there's broader things people are doing, but if you look at the cost of developing a drug, for example, if it's say $1.5 billion and it takes 15 years, tens of millions of that is preclinical work. That's the molecule. And the other 1.45 billion is a clinical trial, right? Now, you may be able to impact the success of a clinical trial based on the molecule. You look at AdMed and other aspects of developing drug, et cetera. But fundamentally, those companies, in my opinion, many of them will end up just being drug development companies. And the question is, do they have real systemic advantages? And so those feel like tougher categories than maybe physics or language or image gen or other areas. And so I think part of it is like, what are you doing? How advanced is it? How interesting is it? How much utility does it have? And the overlay is like, what is the economic model that you're dealing with relative to that type of model?
Maybe two questions rolled up into one here, Elad. So, I think that over the last 6 weeks, there's probably been more encroachment from the foundation models into a number of different domains, right? Thought going out for profit, thought for legal, thought for finance, and obviously of all the coding related things. So I guess the two questions here are how do you as a startup, if you could start companies, how do you think about what is it in the effective blast radius of what these models can do? And then secondly, I guess related to that is, what are the durable moats that an application or a product can have? And I think one of the things you said in the past, which actually resonated with me a lot, was that data is maybe overrated as a moat. Everybody talks about we have proprietary data and we can do better context window stuffing, and that feels a little thin to me and an argument. So two different questions fold up into the same thing there.
So if you look at the history of technology, every time you have a new platform, it forward integrates into the most valuable application in the platform. So for example, Microsoft OS forward integrated into what became Word and Excel and PowerPoint and Access. And they basically killer bought companies that were doing that. And then they forward integrated in the browser. And that was a famous sort of fight with Netscape in the 90s. Google in the 2000s forward integrated into the biggest vertical search categories, right? They did local and they did travel and they did finance. And so this always happens. And so it's not odd that the foundation model companies or labs will forward integrate into the biggest applications, starting with code. Code in particular, though, also has this interesting attribute, which if you have a very good coding model, it helps you generate the next model faster, right? And that's because it helps you write code for it. It helps you with data labeling. It helps you with a bunch of stuff. And so, one of the hypotheses in terms of how we get true liftoff into a singularity is you have models, building models, and then you just take off, right? And so it's not a surprise that the labs are focused on that. It seems like the single clearest vector of speed of change. And eventually we have evolving models and evolutionary trees, and you spawn 50 versions of the same thing, and there's some utility function it races against, and all sorts of crazy shit there, seems likely to happen at some point.
So what is the moat? It's great. We'll be all, we'll be all at the edge of the cemetery.
I got a little bit distracted.
I was going to be like, yeah, set day. Yeah, eat right. Yeah, be happy.
They should ask me questions like this. This is a loaded question. I don't know whether they're going to afford an interim.
Yeah, exactly.
So I think if you look at durability, there's three ways you can be durable. And by the way, if you look at, the whole wrapper around a model thing, I don't really buy, because if you look at a SaaS company, it's just a wrapper around a SQL database, and a lot of things those things is just bind, right? I think usually what you need is you need to build a multi-product company. So there's three theories. One is you're a system of record. You're basically where core data about a thing is stored in all its attributes. And so, that's Workday for all the people working at your company or whatever. And so then you keep all the dozen applications around it, and it's very durable. That's one hypothesis in terms of what creates durability. I think the single biggest thing is just, can you build a dozen different products that you're cross-selling roughly to the same customer or user? They're deeply integrated, and therefore you have multiple workflows. And I think then you're very defensible. So for example, if Harvey has 24 different workflows for different legal applications and use cases, that's defensible. If they're just, let's chat with the legal document, they're not very defensible.
Super observation. I actually haven't, maybe I've said this publicly before, but that's interesting because it's a variant of kind of what Parker always talks about with the tech startup.
It's Rippling, it's HubSpot, it's actually Microsoft.
It's a lot more doable today because you can just crack that stuff out.
Yeah, it's what's the surface area of your product. And I think it's very under discussed, and it's often discussed as a revenue driver, which it is. And, you have different wedges in that you can cross-sell against. You can cross-sell to the same account. It's hugely defensible, right? Because usually what happens is a founder will start a company that build one product, and they'll win because the product is 10x better, and that'll get in distribution. And then they keep going, and they forget the fact that now that they're the incumbent and they have all these customers, that can build a product that's 80% as good as the best thing and still win because they're just cross-selling. They've already done the security review. They've already done the purchasing. They've gone to procurement. They've gone through everything legal. And so it's really easy to start cross-selling, in which case it becomes very defensible, right? It's really hard to rip out a dozen things instead of just one thing.
I was going to say this, why we don't use Microsoft Teams.
Well, Teams is such an interesting example of that, right?
So yeah, it's actually an interesting example of what you said.
Yeah, Teams, it's fascinating if you look at it. So in the early days of a startup, the primary thing you're competing with is other startups. And then incumbents often used to have 5 to 7 years to react, literally, because they could just cross-sell to everybody. And so that's Slack and Zoom versus Teams, right? They would both like this, and then they flattened out, and then Slack had to sell. And the reason is because Microsoft bundled it and Teams gave it to everybody, and they cut off their growth and they won. And so in the olden days, like last decade, you had 5 to 7 years of fighting other startups, and then an incumbent would come in. And if you could escape that incumbent, you won. Now, maybe there's less time for the incumbent to react because you can iterate so quickly on code and the markets are open and everything else. But the incumbent can also build shit way faster, even if they're getting in their own way. And so there's this interesting dynamic that timeline should shorten on both sides. And so we'll see what happens there.
That's interesting though. I mean, you could argue that whatever baseline speed you're starting off, a startup should be able to accelerate it at a faster exponent. So you should have technically an advantage in a world where you can crack out a lot of code. I would argue it's probably still harder for a Microsoft or Google to generate a bunch of, but you never know. Like they're fast moving. They're also good companies.
Yeah, they're good companies, and they have the distribution. And traditionally, probably the biggest headache for them is in that 5 to 7 years, and maybe they have 2 or 3 years, right? But there is time.
There is time. Yeah. What is the most common mistake that you see AI startups making nowadays? Or maybe even call it startups is there a common failure mode that is emergent based on the environment that you're in right now?
I think there's 3 types of failure mode. I think one type of failure mode is your thing isn't working and you stick with it too long. And it's back to you should eventually iterate into something really working. And if it's taking 2 years and nothing's working, you should rethink. In most cases, not all. Again, there's counterexamples. The second thing is there's really bad advice given to things that are working from people who've never had anything work. So what used to happen is you'd get advice from founders who'd seen product market fit to founders without it. And they say, go hire a sales team and scale really fast and burn a lot of money and do it. And that was terrible advice. But it goes the other way. If something's really working and people tell you advice, stay as lean as possible, don't hire executives, don't scale, that's awful advice. And that's where a lot of companies break for a while, and other competitors who are going to scale come in. And it's a very common pattern for things that are working, that founders don't actually build out their company as a product, and they don't really go for it in an aggressive enough manner. So I think that's a big failure mode. And another failure mode is spending money on stuff that just doesn't matter. You start training a crazy model on something instead of just testing something here with an existing like soda lab and just seeing if people want it.
So maybe for that last one, I'm curious. I mean, Elad, you're deploying large amounts of capital, often to a pretty early stage companies. I guess, for a lot of companies that are, raising 100, 200 pretty early on in their, I would say, life cycle, have you found that they actually know how to use it well? It's kind of hard, like if you're like a 12-month, maybe you're training the models. Maybe it's all kind of like ultimately that.
I actually have not funded many things like that.
Okay. I suspect then we have the same priors, because I think it's quite hard to spend if you raise $100 million as a seed round, you can't really pay yourself $100 million, as a founder, you have, you could.
Anybody wants to give me $100 way or face.
You see in the back, or see creation in the back, but some salary. Yeah. But it's quite hard, because your range of what you can pay yourself is pretty bounded, I think, in terms of what is accepted in Silicon Valley. There's only a certain rate in which you can hire great people. It's not easy to hire well and quick. So often if you raise, 100 at 500, I tell people that you can do it, but it requires everything to go right, like for 12 to 18 months. And if you had any hiccups along the way, it's really hard to zig and zag the company, which is actually opposite of what you'd expect. Because most people are like, I raised a bunch of money. Now I can, afford to get it wrong. But I actually think it's much harder to get things wrong. You might have the money, but you don't actually have room to fail. It's kind of my take on it.
Yeah, I think you're setting different expectations for yourself. I do think there are circumstances where you raise $100 million and you build, like what Pi is doing, on the robotics side, we're building these foundation models for robotics. Like that needed a lot of money because they needed a lot of compute. They needed a lot of training data. Great. There's a rationale behind it. I just think it's tough depending on what you're doing. And so it really has to be tailored against what are you actually trying to accomplish and what proportion of it is GPU versus headcount. And often you see people raise big rounds and, 80% of it's supposed to go to GPU or something, and the other 20% is headcount. So you see these differential ratios versus I'm raising 100 just to have people, which I think is a tougher thing for a very early company.
In 11, you came here last. We're going to switch topics a little bit. It's a lot of AI. So we're going to switch topics a little bit. We'll come back to the AI, don't worry. I think when you were here last, crypto and Web3 was still pre the sadness, pre the winter. And I think it's actually kind of, we're starting to see some interesting companies come about again. So I guess trying to, where are you in terms of I would say, whether it be crypto rails, distributed fund-of-funds transactions, in terms of, are you doing any investments there? And there's obviously a lot of talk around how agents might end up being one of the key catalysts to essentially allowing, kind of like the transaction rails that only, utilizing the transaction rails that only exist kind of at crypto and Web3. Are you a bull there? Do you agree?
I think ultimately there's a lot of APIs for payments. And so, anything that's programmatic an agent can interact with.
Sure.
And that could be a stable coin or it could be a traditional payment system, but it's more just like what sort of access you provide to things. And Stripe, I think, has done both, right? Effectively, they've been thinking about agentic APIs for payments, and they've also been doing a lot of really interesting work in stable coins. And I kind of use Stripe as like the hidden crypto company that nobody's talking about that's doing pretty crazy stuff between their acquisitions and, so the acquisition and they've done some really interesting stuff. I'm a long-term crypto bull, but it has cycles and we're obviously in a down cycle right now. And my anticipation, this is not investment advice. My anticipation is that it's going to get worse before it gets better. And if you look at historical cycles, Bitcoin should probably drop to somewhere between say 35 and the 40s. And, maybe it doesn't, it does better than that this cycle and it's in the 50s or 60s or whatever, but it's already in the 60s or it has been. if I do just kind of look at it, you have a very standard crypto cycle and you have a halving and it runs again. It's the same stuff and maybe it not up. People always say I want to apply this cycle and then it applies again and at some point it won't apply anymore. But that kind of drives a lot of the ancillary behavior in crypto because so much wealth in the crypto world will tied up in that you see people trading sequentially across the different crypto assets with Bitcoin as sort of one of the more stable pools. And then you have a bunch of other tokens on top of that. And then you have other companies. And so I think we have these boot bust cycles that also draw founders in and out. One thing that I think is really interesting is there's a certain type of technical founder that depending on when they graduated from school, they either went into crypto or they went into AI. And it's like a 6-month difference. Literally.
It really is.
They've actually done analysis of this in the context of
it's like pre-SBF, post-SBF,
Yeah, seriously, it really is, or pre-ChatGPT, post-ChatGPT, right? Or whatever it is. And it really swings people's outcomes in careers. And there's actually really interesting data in general that I remember seeing years ago, where if you graduate into a recession versus a boom cycle, you make dramatically less over your entire career. And the reason is you have fewer opportunities, you have your jobs, you never manage people early, like all the things that come with the boot cycle you miss. And all the things and the hardness of a bear cycle you hit.
You're just also less optimistic. Like I read that same study, which is that you expect the world to be shitty and do into my life. Yeah. I think you're doing okay. So am I. I think you just expect that like, hey, your expectation out of the world is that growth is low. And that there are larger systemic forces which are actually preventing you from flourishing, as opposed to kind of like YOLO. It's just like, you go up and up, right?
Yeah. And so I think that same thing is, I'm not saying financially, I just mean in general, there was that crypto AI divide. Yeah. And you had founders who started crypto companies and they stuck with them in many cases. And then you had other people who started AI companies and it was a few month difference. It's the exact same type of person. And so I think that's kind of fascinating. And, there's all these weird cohort effects, cinematic, like there's all this stuff we don't talk about that's kind of happening in the background. I think another interesting question, which we can skip if you don't want to talk about it, but I think you also see Silicon Valley kind of moving these 5 to 7 year cohorts of people. And so there's this interesting question of like, how do people maintain relevance across multiple cycles? Or what does that mean? Or why do 2 people who seem equally good have very different outcomes? Is it them? Is it probabilistic? Is it, if you run a Monte Carlo simulation of a person's life, you rerun their life a billion times as the expected outcome of that person? And how do these circumstances impact that? So there's all these really interesting things that you can think about in terms of talent. I'll give you another challenge question. Jensen Huangs, amazing CEO, brilliant, amazing strategist, like so good at running the company in a contrarian way, biggest market cap in the world, like high EQ, very technical, like amazing. For years, he was running a $6 billion company, right?
For 30 years.
For 30 years, he ran a company. And he was this hidden gem of a brilliant CEO who eventually steered things into AI and, game over. How many other Jensen Huangs are there out there running public companies where it's just in a market that right now isn't booming, but they're exceptionally talented? Is it 0? Is just uniquely good? And that may be true. Is it 100? Is it like, how do you identify these people and how do you unlock them? And so I think there's these really interesting sort of talent questions, like what is the aggregate available talent on the planet and how do you harness it in different ways that I think is kind of never discussed really.
I'm curious to get you kind of mentioned one of the central questions in Silicon Valley, which is, are there not enough good opportunities or are there not enough, good founders? But where do you kind of almost fall that?
Most likely there's enough good founders who're just not pointing at the right things. And so it's an ineffective, or it's a faulty search function. And if you think about it, entrepreneurship is a distributed search around the economic landscape of the world. That's really what's happening, right? You're really running a giant search function across the economy. And it's not an efficient process. And there's, unequal information and unequal access and all the rest of it. And so it doesn't work well, but I think there's probably enough good people that if you pointed them in the right thing. Now, the flip side of it is, if you ask people how many great product people exist on the planet, I asked a very well-known public market CEO who runs one of the most interesting product companies that question. I said, how many great product people do you think exist in Silicon Valley or in tech? And he said at most a few hundred. And so then each company has at most a couple of those. And those are the people with high agency who are grinding big things for those very large companies, right? And so there's now he may be wrong. Maybe there's tens of thousands in the wrong sort of sets, or maybe there's like 50. I don't know. But it is striking if you look at the overlay of, if everything's a bell curve, then you need outliers on multiple aspects of multiple bell curves to do certain things exceptionally. And so then you're compounding small probabilities. So one argument is for any given thing, there's not that many people. And one of the parts of that bell curve is almost always agency.
I was going to say, I actually think that the most, the longer that I am in Silicon Valley, the most determining bit that I find is actually this like agency. It's like kind of given a particular situation is your first reaction is like, I'll just do it. I'll just like do things. I'll figure it out. Like that isn't it? Like given any problem, your reaction is not that, oh, this seems super hard. It seems too possible. It's more like, yeah, I have to do it. We'll figure it out. There's some way. There's nothing that can in some way stop you. That doesn't mean you won't get stopped. But your first reaction is always like, oh yeah, I got to figure it out. I'm going to guide my way out of it, right? I think the open question for me and my variant of it was, is that something that can be truly inculcated / taught / developed? Versus is there something a little bit more intrinsic about it?
Yeah, it's both.
I think it's probably both. And I think, one of the questions I ask at the end, which I'll probably just ask now, which is, in this incredible age of technological capabilities, what do you want your kids to have? And the first answer is just like agency. It's like, I want all my kids to be like,
I thought you were going to say Bitcoin. That's what I think of. Yeah, Bitcoin. It's that agency.
So my Ruchi's brother was visiting us this last week. And turns out that I gave all of his children a bunch of Bitcoin 6 years ago. And then I asked him, like, do you know where the keys are? And he's like, lost it.
Agency sounds like the right answer.
Anyway, agency. Okay, coming back to it.
You can buy Bitcoin ETFs now, by the way. So it makes it...
But they also go down when Bitcoin goes down.
Yeah, they have an ETF. So I own keys. Yeah.
It's interesting. So Elad wrote a great book called the High Growth Handbook. Ruchi actually has a chapter in that book. I think it's the Wolf. It's kind of named after Pulp Fiction's Harvey Keitel, kind of like character, the wolf. But that was, High Growth Handbook was written, 10 years ago?
Something like that, 7 years. That's been a while.
What's the biggest thing you would revise or update it?
And make it shorter. No, just kidding.
Can the AIs read it well?
Yeah. So, yeah, it's been AGI on it. Yeah, I think a lot of it is still reasonably relevant because a lot of it was about people related stuff. It's true. Or the basics of fundraising, or how do you fire somebody for the first time, or how do you hire executives, or how do you do M&A, or, so I think there's some aspects that were kind of moment in time, like for some of the major funders of startups and stuff like that. And there's like a section on that. But I think in general, it reasonably still kind of works. I think I'm actually writing another book for startups asked me to write this, which is more about the 0 to 1 phase of startups.
Okay.
And so I've been working on that, and that's been pretty fun as like a project.
That's cool. What is high growth even meaning for 2026? Like when you take a look at kind of like a company, what is your marker for like that is gangbusters will grow? Like that kind of fits into the Elad Gil, like you will definitely pay attention to the numbers.
Yeah, I don't have anything prescriptive because I think it's a little bit market segment dependent. And so if you're looking at like a defense tech company or something, it's going to be pretty different than if you're looking at an AI vertical company. But in general, everything is growing faster than one would expect. And on the AI side in particular, obviously we're seeing these massive ramps. I think Cursor now rumored at $2 billion revenue or something like that. I was just, what an insane ramp. And you see multiple companies growing really fast. Harvey's growing really fast, like Decagon and others are growing really fast. So you just see these things lift off. And I think it's back to like these markets are open, the capabilities are massive, the transition is large, the ability to iterate on product is high, everybody wants to try things right now. So again, it's a very magical moment and a very manic moment. And, I was looking back in history at the 90s, and in 99, 450 companies went public. In the first few months of 2000, another 450 companies went public. And so say that you had 1,500 to 2,000 companies go public over a 5-year span. How many of those are still relevant? I don't know the number. It's a dozen, 2 dozen. It's very, very few. Most of the companies went to zero. Those are the most successful companies. They went public, right? It's not the average company. It's the most successful companies, 90-something% are just gone. And so then you think about that in the context of AI and you're like, okay, most of these things are not going to exist. A handful of things are going to be Amazon and Google and et cetera, right? And so then as a founder, how should you think about that? And for every company, there's a handful of companies that'll keep going forever, right? That's probably OpenAI and Anthropic and few of these things. They'll just keep going forever. There's a lot of companies that are looking really good right now. They should probably sell at some point. And for every company, there's like a 12-month period, which is sort of the value maximizing period that's going to be the most valuable and important it'll ever be. And then in many cases, these things go to zero or close to it. So one thing that some people do to have good hygiene around this, and by the way, I think there's some companies that should absolutely never sell, right? The companies that really work should never, ever, ever sell. But how do you know if you're one of those, right? And so good hygiene, I think, for companies, especially if you have a board, is once a year to pre-schedule a board meeting that's talking about exits. Should we sell? And if so, do and is this a value maximizing moment? And because you pre-schedule it and it's annual, it takes the emotion out of it. It doesn't look like you're trying to sell or want to sell. It doesn't look like you're against it. You're just going to have a rational, logic-based conversation on the market, on competition, on your position, on your growth rate. Like if your growth is like this, that you see the second derivative changing, that may be a good time to sell and so you can fix it, right? And so I think it's worth just having that conversation ongoing. Because again, in most of these cycles, 90-something% of things end up not working, even if they look like they're working.
Do you think the CEO's job in today's world is a little different than it might have been in the past?
So,
should every CEO, do they have to be building at an example? Is it possible to kind of be at the forefront of this technological?
Was Steve Jobs building? Was Jeff Bezos building?
Did they have access to cloud code?
I don't know. Who knows? That's why Amazon's so successful.
I think Jeff Bezos is back to building now, I hear.
Well, how do you define building? Yeah, right. He wasn't technical. And so he hired some guy to build stuff. If you look at Uber, right? Travis has talked about this publicly. Travis and Garrett set it up as a side project. They found the CEO, Ryan, on Twitter. They literally tweeted, hey, we have this side project. Who wants to run it? And somebody put up their hand on Twitter. That was Ryan Graves, right? And then I think they initially outsourced the app to third-party developers and then brought it in-house, right? That was early Twitter. Early on Uber.
Excuse me. We're CEO.
Yeah. And they found him on Twitter. Right? And so were they building?
Yeah, good point. But Garrett always says he built the first work. And
maybe he did.
But your point, did he build it? No. What is that?
Again, I wasn't in the middle of it. I'm just saying it's interesting to look at historical precedents. And I think we have all these myths. And it may be 90% true.
I was just actually walking by the Cove office, which was 148 Townsend the other day. And I remember because it was impossible to get a fucking cab in San Francisco. So my first ever Uber was the Uber Black and from 148 Townsend to our house in Noe Valley. And it was amazing because I'm not finding a cab in San Francisco. So I was just thinking about that.
One aside, by the way, I do think builder CEOs tend to do better.
Yes.
On average. So I'm not at all negating that. I'm just saying there's counterexamples. And it's because they're in the weeds on the product or detailing that they're doing stuff. They don't need another person to enable them so they can't ship things and do they. So there's all sorts of reasons why it's a huge pot. So not at all. In general, I tend to work with technical founders. I'm just saying it's at least there are examples where that isn't true.
Yeah, maybe the larger follow that question is more is a CEO need. Should they be a little bit more hands-on than they were 5 years ago? Because the tools because in 5 years, if you're essentially, the bifurcation between manager mode and maker mode was pretty stark.
I think people should have always been hands-on, and it's back to, but I think micromanagement is underrated.
I think being able to be is underrated.
Yeah, no, I agree. I think, and I think that's transitions come back. I think basically it went from delegate to actually you should delegate a ton of shit.
Yeah.
But there's a lot of things that you should be on the weeds on, and there's a lot of things that you personally should micromanage, and those are the most successful companies. And so I think it's that balance. It's not one or the other, and I think people have over-indexed in either direction over time.
You should actually micromanage the stuff that's the highest leverage and the most important things.
And the here actually get up.
Yeah. Thank you. That's a comment.
I have a fun.